Please stand by. Good day, and welcome to the DoubleLine Asset Allocation Webcast, Low Duration Core Fixed Income and Flexible Income Funds conference call. Today's conference is being recorded. At this time, I'd like to turn the conference over to Ron Riddell. Please go ahead.
Well, thank you, and good afternoon, and welcome to the DoubleLine Asset Allocation Webcast with Jeffrey Sherman. If you'd like to see the rest of the webcast schedule for 2022, please go to doublelinefunds.com to review that. But just to highlight three upcoming webcasts, please mark your calendar, October 25th. We'll have our Smart Beta webcast with portfolio managers Sam Lau and Jeffrey Mayberry. They'll discuss our Smart Beta products within the suite of our Smart Beta strategies. Then on November 8th, we'll have our International Fixed Income webcast with some of our portfolio managers from our emerging markets and global bond strategies. And then on November 22nd, we'll have Ken Shinoda, our portfolio manager of the DoubleLine Income Fund, up. If you'd like to receive a copy of today's presentation slides, you can go to the webcast player and click on Request Webcast Contents. Our Twitter handle, if you want to follow us, is at DLineFunds. Also to highlight DoubleLine's thought leadership in the media, we have two YouTube sites or addresses, DoubleLine Capital and DoubleLine Funds. But on the YouTube channels, specifically on DoubleLine Capital, we have our very own DoubleLine's Channel 11 with Ken Shinoda, and also to highlight a new series on our YouTube page, DoubleLine Capital. It's hosted by our product specialist team, where they'll explore DoubleLine's latest thoughts on the financial markets, macro events, and drivers of returns in various segments of the market. Also want to highlight the Sherman Show podcast, the widely acclaimed, with our very own Jeffrey Sherman and Sam Lau, and then also Monday Morning Minutes with Sam Lau and Jeff Mayberry. Some brief disclosure. And today we'll be discussing three open-ended mutual funds, the DoubleLine Low Duration Bond Fund, DoubleLine Core Fixed Income Fund, DoubleLine Flexible Income Fund, and then our new ETF. We have two ETFs that we've launched, but the one we'll be discussing today within asset allocation is the DoubleLine Opportunistic Bond ETF. Ticker on that is DBND. Here you can see the different expense ratios and minimums for open-ended funds and the gross expense ratio for our new ETF. I want to briefly just cover the standardized performance of the four products. The first one is the DoubleLine Low Duration Bond Fund. The inception of that fund was September 30th, 2011, so 11 years, and 1.76 on the institutional share class annualized return versus the ICE B of A 1 to 3 year U.S. Treasury Index at 0.6%. So an annualized outperformance of 1.16%. The DoubleLine Core Fixed Income Fund launched June 1st of 2010 through the third quarter of this year, annualized on the iShare of 3.17% versus 1.88% for the Bloomberg Ag. So an annualized outperformance of 1.29%. And here you also can see our 30-day SEC yield now at 4.89%. The DoubleLine Flexible Income Fund, we launched that April 7th of 2014 through the third quarter, an annualized 2.03% versus the ICE B of A 1 to 3 year Euro dollar index of 1.25%. So a 78 basis point annualized outperformance. And here you can see the 30-day SEC yield at a net 6.5%. And lastly, our new ETF, DBND, DoubleLine Opportunistic Bond. We launched March 31st of this year, so 6 months into it. You can see the NAV performance minus 7.6% versus the Bloomberg Ag at minus 9.22%. So an outperformance for that 6 month period of 1.62% and an SEC yield of 4.16%. So without further delay, I'm going to turn the webcast over to Mr. Jeffrey Sherman.
Okay, Ron, and thanks everyone for joining. Thanks for the intro there, Ron. For those of you that were on our webcast about 2 weeks ago, we were out there talking about the macro environment. Not a lot's changed in that, but boy, have markets moved significantly. There's been a lot of market moving events. So let's run through it again. Let's talk through the macro. It's going to be a little more detailed on the macro today, as this really impacts the way we think about our asset allocation across our funds. So I just want to start with a review of what the world looks like today and what we've seen in world GDP forecasts. And I'd like to remind everyone that there were the aberrations over the last decade or so of really were in 2020 and 2021. And the world has had a relatively consistent growth rate. And when I say that, it's vacillated between about a 2.9% and 3.7% throughout the last kind of decade or so. Again, the aberrations were 2020 and 2021. And you can see that 5.8% growth rate in 2021 did offset, or more than offset, what we saw in 2020. Kind of the bad news is that we had a very optimistic economic forecast across economists for 2022, and that has started to really ratchet down as the years went on. And so the continuation of kind of the good times seem to be looking at we're kind of back to more those trend line kind of exposures, and digging into the weeds, just trying to figure out what is driving that. It's essentially every part of the globe today. And what we're looking at here is something called the economic data change. What it does is, for these various regions, it compares the amalgamation of a bunch of economic data points, and it compares them to where we've been on average over the last 12 months. And so the key takeaway here is that with these negative signs, the economies on a global basis, various regions, are underperforming where the data had been over the last 12 months. It's not surprising, as we've seen a global tightening of financial conditions through central bank policies across the globe. But you can see here that some of the data is kind of improving a little bit. And the big outlier here is really China, where even though it is a lower rate than where it has been on average for the last 12 months, it is starting to improve a little bit and being less worse. The bad news is the rest of the regions are still trudging along in that kind of negative environment after really doing so well back in 2021. And so again, this is kind of the wake up that we're seeing on the macro front. And I think a lot of this has to do with what we've seen, again, with tightening policies across the globe. And what you're finally starting to see is a contraction in global manufacturing. If you see this is what we call a diffusion index. And so what it looks at is that if it's sub 50, it says that we have on, when you do the surveys, it's more contraction than expansion. And when it's above 50, it's more expansion than contraction. So you can see on average here, we're in a slightly contractionary environment from a manufacturing construct around the globe. And looking at the inflation data, the PPI data, we'll cover some of these for the US, but what we've seen is just, especially through the Eurozone, how they've been hit so significant with their energy crisis over there as well. So again, this does not portend to well. You can see that there have been times where the global manufacturing did indeed go into a recession and did not lead into a recession in the US. So just because this is in this slightly contractionary territory doesn't mean recession's imminent. However, our antennae are raised about the recession risk here in the US, and I'll dig into that very shortly. If you look at these economic surprises, though, I remember the last one I looked at was economic data change, and that's just talking how the data is coming in. This is how the data is performing relative to expectations. And so we use a lot of sentiment indicators to think about directions of markets. And you can see here that the U.S. is one area that continues to surprise through the economic data set relative to expectations out there. So all is not lost, even though we're seeing this kind of correction relative to where we were the last 12 months. But the market is continuing to slightly surprise to the upside relative to expectations. And so again, this is another chart just specifically on the US. And when I think about, kind of the long-term real GDP prospects, I like to drag this chart out every a couple times a year and just show people what the trend line growth looked like in this country. And I say look like, this is the post-World War II era. And you can see here that relatively consistently, this trend line through the financial crisis in 2008, you had this relatively stable growth rate. And this is done in a logarithmic scale. So the slope of the line is the growth rate of the economy. But you can see here that something changed back in 2008. And the something that changed is that, we had more of a disinflationary environment. We did lots of quantitative easing, again, coordinated efforts around the globe. And it really lowered the productivity rate in the US. And so our GDP growth rate, as you can see, it's been pretty stable since 2008. And if you actually looked at that time series, you'd see it grew prior to the pandemic at about 2.3% per annum versus that long-term trend that's in the low 3 handle. And so I think this is the line of potential that we can get back on. And you can see that from the pandemic, we had to dip back down. If you kind of extrapolate that line just from 2008 going forward, you'll see we're relatively on trend. The bad news is because of the last 2 negative quarters of GDP that came out, we're now kind of a little bit below that trend line again. And so the forecasts there are from the IMF, how they look at kind of U.S. GDP going forward. You can see that they think that it's going to be a slower growth rate for the next couple of years. And to put it in perspective, when you talk about the drawdown, here's what the drawdown looks in real GDP. And the shaded areas here are recessionary environments. And when you look at this, you can see that there's nothing that argues for what GDP should decline in a recession. You can see back in the recession in the early aughts, GDP only declined roughly about 50 basis points cumulatively. You can see in the global financial crisis, it did worse. Obviously, the pandemic with locking down the global economy was significantly worse. But you can see here that this drawdown, sometimes we have these head fakes where it doesn't lead to a recession. And if you look at the forecast for third quarter GDP, whether you use something that is a model like the Atlanta Fed GDP Now estimate, which is around over 2.5% today, potentially we can get back to where this line, kind of offsets the declines we've seen thus far in the year. And so you put that together, and again, I talked about the relative stability of the growth rates across the globe, and you can see that here also for the U.S. And the range has been roughly about 100 basis points, the worst year being 2016 at 180 basis points, and the best year being 2018. Maybe that's why it was called the greatest economy ever, back at with that 2.9% growth rate. Again, the aberrations in 2020 and 2021, but you can still see here that there is this decline in the forecast for real GDP for this year as well in the U.S. And again, I don't really pay much mind to the forecast for 2023. I think the Fed themselves has a forecast about 50 basis points for next year. But again, you see that we are definitely in this slowing environment. And the reason we're slowing is that because we have a lot of inflation in the environment, we've had some asset price degradation, as we'll talk about in financial markets. But again, looking at nominal GDP, this is actually still forecast to be one of the greatest years in nominal GDP that we've seen since the mid-'80s. Now, the bad news about that is the bulk of that is coming through this inflationary environment. And so you can see just what that looked like last year when we had a solid growth rate coupled with kind of, I'll call it moderate-ish inflation. We had about a 5-handle inflation last year. You can see that, I think we'd all root for that 5-handle inflation today with some of the prints we've seen out there being north of 8% or so. But again, when you think about nominal GDP, this is kind of how you offset your debt burden through time. So I think the Fed has welcomed a little bit of the inflation. I think they wanted to have some inflation in the system. That's why they adopted this average inflation targeting. But now with the levels of inflation, they're singing a completely different tune. Maybe they wanted a 3%, 4% inflation rate to offset some of those underperforming years in inflation, but they're sure not content with having this 8%. And so that's what's caused a lot of challenge in financial markets today. Again, GDP is a very slow-moving indicator. So one thing we look at to kind of use it as more contemporaneous data, there's a weekly time series published by the New York Fed that's called, not surprising, the Weekly Economic Index. And what it's trying to do is kind of estimate GDP and activity throughout the economy. And you can see it does a relatively good job of getting you in the direction and roughly the magnitude of what GDP looks like. And so what it's forecasting at this stage is about a 2% year-over-year GDP growth rate. To be precise, it's 2.1 at this point. And, it kind of seems in line with where the market pricing, the economists' expectations are for GDP. So again, nothing wrong with having a growth rate there. We're just kind of moderating. Again, we overshot to the downside during the pandemic because of all the amount of fiscal stimulus as well as the monetary stimulus we did. We overshot back to the upside, and we're kind of getting back in that moderate area. Now, the question is can you come off these high levels and really hit back to that target area, or do you overshoot to the downside, which would cause a recession here? And so that is the $90 trillion question in the markets today is, can the U.S. stave off the recession? So let me start with some of the bad news. We'll talk about some of the more positive news, and we'll talk about what this means for markets. And so one of the indicators that we really like to focus on is one that's an amalgamation of 10 different indicators together, and it's called the Leading Economic Index. And so what you find here is this measures economic activity. It does have things like the stock market in it, so that's weighing down on the index as well. But you can see here that the rate of change has went negative on the 12-month basis. We look at the 6-month average as well, or the 6-month annualized rate, just to see kind of what that magnitude and that velocity is behind the most recent data prints. And you can see here when you start to go negative, especially where you see the 6-month number being as negative as is, typically it leads into a recession. And so you do get some head fakes when the year-over-year number is slightly negative. You can see that through some of the annals of history here. But in general, again, this is something that has merit. It has pretty good credibility for forecasting the recession. So this definitely puts us on some form of recession watch. What's pretty amazing, though, is the budget deficit. We know how strong that the last kind of administration was to expand the deficit during good times. And if you listen to us over those periods, we said, oh, when we hit the next recession, the budget deficit is going to have to explode. It's probably going to double what we saw in last kind of experience. That's exactly kind of how it played out. What's amazing to me, though, is the recovery in this, right? The amount of fiscal restraint we had for a period of time after going on this massive spending spree, both to the public but also to corporate America. I would like to remind everyone that of that fiscal stimulus, corporate America got about 2/3 of it. The lot's blamed on the consumer and getting free money, but we gave more free money to corporate America as well. What you see here is that this is roughly back in line with where we are when we come out of a recession. So the bad news is if we are on that recession watch and we're going to have to roll over, or we do roll over, we're going to have to throw more money at this. So it wouldn't be unlikely to see us running a deficit north of 10% once again, if indeed we get into the next recession. So that's probably why the Fed itself wants to do quantitative tightening, why they want to shore up some of their balance sheet. So essentially they can reload the balance sheet for when the next time comes for doing fiscal stimulus, that the Fed can be the buyer on the monetary side. And to put this in perspective, and this chart just never gets old to me, looking about how unprecedented this money printing was indeed to stave off the pandemic, or at least to provide support to both people as well as corporations during this, is that we got to where we increased the money base by over 27% during the pandemic. And to put this in perspective, in some of the more recessionary environments, like in the 70s, we got up to 12, 13, 14% increase in monetary supply, but it reversed quite quickly. We've never seen kind of the numbers that we did see indeed back in the pandemic. And, it's not shocking people say, well, this is why we have inflation today. And you can't talk about money supply without also talking about velocity at the same time. But if you look at that panel at the bottom, can you imagine what the inflationary environment would be like if that velocity was anywhere near the levels it was pre-pandemic? And you're starting to see a little tick up in velocity. That means just the money's turning over. Some of it's offset. It's kind of offsetting some of the decline we've seen in the increase in money supply. And in fact, if you look over a 6-month basis, the money supply has actually decreased. So again, this is some of the, I'll call it fiscal restraint. It sure doesn't feel like it when you listen to Congress, but they have had a fair amount, during the course of this year. I know there's the Inflation Reduction Act on the table. More spending policies. I'm not sure how spending reduces inflation, but at least it has a catchy name to it. And I bring this chart out again because we wanted to show, we used to use this chart to show how easy monetary policy was last year, and trying to understand why the Federal Reserve was so committed to continuing quantitative easing to be accommodative to the marketplace, and why weren't they trying to raise rates a bit sooner? And what this is the Fed funds target rate less CPI. So yes, CPI is a trailing indicator. The Fed funds target rate is where it is. But you can see here that first of all, real yields were more negative than they ever have been, kind of in that post-World War II era. That's the first thing. So more accommodative from a Federal Reserve than we'd seen. Secondly, you're starting to see a decrease in this amount. That's why the chart is moving up. And this is because the Fed is hiking, right? You've got roughly 300 basis points, or I guess it's 275 basis points of hikes into the market thus far. And so what's happened here is that it's brought that number up, even though inflation has stayed relatively constant. Why I bring this up is that Chairman Powell at the press conference said he wants real yields to be positive. Okay, so is he talking about Fed fund policy rate potentially. And historically, the way that you combat inflation is to have a Fed funds rate that is above the inflation rate. And so if you think about that, what does that mean? That doesn't necessarily mean we need to get to an 8-handle Fed funds rate. I think we all could agree that if they did that, if they did that over the course of the next year, they're going to roil markets. They're going to throw us in a significant recession because, again, debt markets can't handle those type of yields today. That being said, what you also think about is the path of inflation. I'll talk about that in a few slides ahead of this. About the path of inflation, what we think it kind of can look like. And so you want to see a convergence in these two rates. So I won't steal the thunder from the rest of my presentation later on, but I think that the point is if the Fed can get inflation down and it can moderate to something in the 4 handle, at least the way the market is pricing Fed funds policy, it would indeed turn this rate to a positive real rate as well. So let's talk about inflation. It's on everyone's mind. If you look across the globe, this is a global phenomenon. And so I know I talked about, the fiscal stimulus we did in this country, the money printing we did, increasing the money base through M2. But this is a global phenomenon. And what you see here is the only one not really experiencing this extreme level of inflation is China. Some of that has to do with the policies, the zero COVID policy. Now, the slowdown in economic activity did not lead to as much inflation there, but you can see that the whole world is experiencing an inflation rate very similar to the US. And so again, as we talk about tackling these policies, there's a reason that you have this coordinated effort from central banks around the globe. And the one who's been defiant in all these of the major central banks is the Bank of Japan. The Bank of Japan does not have inflation. I should have Japan on here as well to illustrate their inflation levels. But what's happened because they've been left behind this rate hike, you've had a massive degradation in the yen. And so their currency has been the thing that offsets that valve because they've been reticent to raise rates because they don't see it being an internal problem within Japan. So again, I like to illustrate that this is a global phenomenon. And so we have to work together, coordinated globally to fight this inflation problem. Coming back to the US, measures of core inflation, there's many different metrics. They're all giving you a signal that inflation is way out of the comfort zone of the Fed, right? If the Fed has, the 2% target, that's why we have the dotted line there. They typically use personal consumption expenditure, which is the PCE. These are all core data sets, so they strip out commodities such as food and energy, again, to try to bring more stability to the time series. But what you find here is that these numbers are numbers and levels that are just unacceptable to the Fed. This is why they've been adamant about hiking. This is why they continue to hike, and they're going to continue to do so through the end of the year because, again, the indicators they're looking at, although some of them are not forward-looking, like the leading economic indicator, some of them are backward-looking, things like the labor market or inflation. They're just out of levels that are way out of the comfort zone of the Fed. So that's where we are. Digging deeper into CPI, there's kind of two ways to think about CPI. There's two components of it. A third of CPI is really driven by services. 2/3 is driven by services, and 1/3 is driven by core goods. And so we saw the big spike in core goods. The inflation we saw there was a lot of it was supply chain driven. Some of it was just, again, fear of rising labor costs. And so the price of goods went up to try to offset some of that. Think about profit margins back in the second quarter. We're near the last 40-year highs in the cycle because what happened is companies started to price some of this in. So you saw this in the goods area where there was significant demand coming through because of the changes in taste and preference during the pandemic. And again, some of that was a handoff from services over to goods. Now, remember, these numbers I'm showing you here are the year-over-year change for these components. So what this is saying is that both sides of the equation are driving some inflation. The good news is on a year-over-year basis, we're starting to see at least some declines off of elevated levels. Yes, it's still accelerating year over year, but the month-over-month numbers are coming in kind of relatively flat to slight decline. So if we go back to what's kind of a more normalish time, you would see that goods inflation hasn't been at these type of levels since the early 80s, right? Again, a consumption-driven economy. And so this is another thing the Fed wants to see come down. If you look at over the last decade prior to the pandemic, goods actually had a deflationary environment. So they were actually going down in price. Now, you could say, well, I was shopping for goods. I've never seen a decline in price. Well, it's because economists use something called a hedonic adjustment, which adjusts for the quality of the good as well. So it may be the same price for that good, but if it has more bells and whistles, think of like an automobile has significantly more technology. That even if it was the same price year over year, it would see a deflationary kind of component the way this is measured. But more importantly, what is skyrocketing right now is services. And there's probably there's twofold going on with here, and I'll talk about this in the next chart. One is kind of the unleashing of the pent-up demand. People talked about pent-up demand to do things over the last couple of years, and we saw that. You saw this through what people call the revenge travel out there, right? It's a phrase I like to use it, where people say, I don't care what it costs. I don't care how much the airlines are gouging me. By the way, the airlines gouged people massively on ticket prices this year. In some cases, they were up 3 to 4x for what they were, pre-pandemic levels. But also just that it said, I don't care what's going on. I want to take a vacation. I want to go somewhere, spend time with the family. And so you see this in the core services. But the other part of services is actually the housing market. And that's what I'm going to focus on in a few more slides too. I want to show you this, what's driving this. And this is what's going to be problematic for the Fed, because if you think about the housing market, it's roughly 40% of core CPI. Now, remember, the Fed doesn't use CPI. They use PCE. PCE, inside of that, the housing component's only about 20%. So again, these housing pressures won't have as much influence on their measure. But again, most people think about things, bond market prices in based off of CPI. And so we put together a chart here trying to distill down the components of this, really trying to illustrate what's driving the inflation data underneath the hood. And so you can see here that we have goods in the shaded gray area. Now what this is a stacked area chart, and the shaded areas are the contribution to overall inflation. So it's the weight in the inflation index times the inflation rate of that component. So what we do is we take goods, and you see how that's the gray area. So you can see those kind of deflationary things I showed you from the last chart. You see how it's exploded in the last 2 years. We take services, but instead of just using services in aggregate now, what we end up doing is we split it out to services X shelter, and then also we look at the shelter component itself. And so you can see here that if you go back through the last 30 years or so of data, you can see a lot of that stability of what's driven CPI. Well, first of all, it is the services sector in aggregate. Not shockingly, again, if you think about some of that deflationary pressure you saw in goods, but look at how much the housing market and the other component drives the overall CPI level. And why I point this out today is that even if you got goods inflation to zero, right? Let's say that goods number comes down to zero and the rest of the services are still zero, right? That means just on a standalone basis, the shelter component would be enough to have the CPI rate at roughly 2.5%. And so this is the challenge that, kind of the Fed has as they're trying to fight the inflationary environment, is that some of the data is indeed lagged, and the housing component is notoriously lagged. It's done so to try to smooth out the data series. And so we haven't seen all of the impacts of what we've all experienced in the housing market over the last couple of years feed through into the CPI loop. So this is why it's going to be very challenging unless there's a massive rollover in the housing market and the rents market specifically. It's going to be challenging to get down to this 2% rate in the near term. And so that's one of the headwinds that the Fed faces. Now, you can look at the rent component. This is the month over month change in rents. And you can see that we did have some deterioration in rent prices last month. But again, look at how large those increases were in 2021 and 2022. You can probably see from this chart, there tends to be some seasonality in these series. So strike out 2020, look at 2018, 2019. This is typically the season where you see there's less transition. A lot of it tends to be weather related. People like to move in the springtime. Some of it's also school related. They want to keep their children in the same school system, and they're not looking to move. And so potentially this could create, kind of some degradation in price. However, you can see here that the rent increases for the past couple of years have been massive, and this is starting to feed through into that system. The other thing that the Fed uses is something called owner's equivalent rent. which strips, it doesn't use rent. It's a survey that asks people, how much can you rent your house for? And so what I'm showing here is the Case-Shiller indices. These show the year-over-year growth rates across various composites, whether it's the national prices, the 10 city or the top 20 cities. And you can see that it's still on a year-over-year basis, they've been growing at 15%. Well, if you go back to my chart and you say, okay, if you get roughly a 2.5% inflation rate, strictly from shelter, and let's say it's 40% of the index, well, that backs into, you probably have a 6% or so. It's a low 6% growth rate or inflation rate within the housing market. It looks nothing like what's happened in the housing market. And, it's probably very non-controversial to say that there's likely some challenges in the housing market in the short term with interest rates where they are. Mortgage rates are north of 7% today. I'll say that again, mortgage rates are north of 7% today. I was meeting with the client today and said, well, I don't care about 7. When I got my first home, it was like 8.5. This seems like normal pricing. And it was like, yeah, but that hasn't been the price for the last 20 years or so. So this is a challenge both for the headwinds for some of the real estate sector. I can envision seeing a massive slowdown in transactions, just given affordability levels, affordability driven by the price increases. But secondly, just on mortgage rates where they are. So potentially the perverse effect that this could have is it actually could put pressure on rents. Right? It's too expensive to go into housing, to buy a house. You can't afford the financing with the down payment, with the lending standards where they are. And so it could indeed put some more pressure there. So again, I want to focus on shelter because, again, we think about this as it's slower moving time series to adjust to kind of the market conditions. But at least the good news is that we're not still growing at 20% year over year rates. We all know that that is untenable. The other good news about the inflation side, and again, makes me more hopeful on the good side of the equation, is that you find that the supply chain bottlenecks are coming down. And so you can see here this magnitude was really something that you haven't seen really in a while there, back kind of in that 2011 era, 2012 era. There's a little bit more supply chain. Some of that had to do with some of the trade out there. But you can see that, again, we're coming up these very elevated levels. So hopefully that drives some of the goods component. Again, remember, goods is only 1/3 of the core inflation numbers. But again, it is giving you some signs of positivity that indeed inflation may indeed be slowing down. We can also look at the manufacturing and the non-manufacturing PMI data. Here you can see manufacturing here is starting to decline. It's still in this expansionary type of environment with the 50.9. The trend is definitely not your friend here, but you can see that when manufacturing goes in that contractionary space, it doesn't necessarily throw the U.S. into a recession. And that's because we are indeed a service-based economy. You can see that if you have both the manufacturing and the services be persistently below that 50 for a period of time, that's what tends to lead you into a recession. And so the good news is services continue to stay there. We see this in some of the jobs data that there's hiring. Some of that's probably going to be hiring for the holiday season as well. But services have stayed relatively resilient. Yes, they were very high last summer. They were truly off the chart readings back then. And so this looks like decent economic activity. So this does not portend, necessarily that the future is going to have these levels, but this is where we are on a backward-looking basis. Another thing that makes me optimistic about the inflationary environment is that if you look at the diffusion indices for prices paid, you can see that they plummeted as well. So the price increases across the survey respondents, they're being significantly less than they were before. And so this tends to lead CPI. We have CPI on a 4-month lag relative to the prices paid indices here. You can see the correlation isn't extremely strong. You can't really just overlay them, but the directionality tends to be relatively consistent. And so, again, this degradation in prices paid hopefully leads to further CPI downward pressure. And another way of thinking about it is looking at the cost of inputs. This is called the Producer Price Index, or PPI. This tends to kind of lead, this is the input cost, right? So seeing some deterioration here is a helpful signal to get us, down in our PPI estimates, which tend to lead CPI as well. So there's signs that the pressures are being released. Some of these policies are doing there. doing their job. Some of it's going to be economic activity with some of the slowdown in certain industries that we're seeing to date. And in general, these are positive signs for the inflation market. And the bond markets listen. I met with a client yesterday that said, yeah, Jeff, the break-even spreads, whatever, it's never been a good indicator of how inflation's about to play out. And I said, yeah, it's just like any forecast, the bond guys aren't much better than the equity folks when it comes to forecasting. But what you find here is that the market is starting to get some semblance of that 2% target again. And this is important when you think about the Fed, because the Fed doesn't just look backward. They also use a lot of survey data and things about kind of market levels that they think about. And so the market pricing in that we're going back to roughly a 2% inflationary environment over time, I think the Fed will view this as a positive. I don't think this leads them to want to stop hiking in this part of the cycle. But again, this is something to keep inflation expectations well contained. You've heard that from the chairman all year, that it's all about the expectations and not having unanchored expectations. Expectations are getting pretty unanchored at the beginning of this year. Look at where that 5-year break even was, 375 on the high print. And those expectations have come down a fair amount of this year. And so, again, as I look at the inflationary environment, there are signs that we're going to get the inflation under control. The fear of markets and the fear that we have at DoubleLine is the Fed overshooting, over-engineering the process, trying to focus on getting the inflation rate back in line, and over-hiking through this regime, coupled with quantitative tightening that can cause kind of the setup for the recession here in the U.S. And so we know the unemployment rate continues to be quite low. It did tick up to 3.7% 2 months ago. The latest print from last month is down to 3.5% again. That was labor force participation, kind of ticking back down from that aberration last month. So another thing the Fed's going to use is going to say, look at the employment market. We're in good shape. We know labor is a lagging indicator, though. And so firms don't usually lay people off thinking about an impending recession. They usually do it once the slowdown has already occurred. And so, again, this is something meaningful to watch. We have some charts at DoubleLine that we look at where we compare the unemployment rate to the 12-month moving average and the 3-year moving average. And what you find is that once you cross that 3-year point, typically a recession is imminent. But again, right now, the 12-month number is about 4%. So we are a little bit of ways away from that. Another thing I want to show is that people getting unemployment insurance benefits were back below pre-pandemic levels. So I think this is very important. We supported people for a long period of time. You can see that from all the programs we did, the number of folks receiving these. So these are continuing claims is what we look at. This comes on a weekly basis, so it's more frequent than a job report. And you really have not seen an uptick in data here. So again, so far, the labor market has stayed relatively intact. And you see this from the jobs numbers. This is the non-farm non-farm payrolls report, what we call the employment report or the establishment survey. And we now have more people employed in the economy than we did on kind of that pre-pandemic levels. And you can see here, you really can't extrapolate trends because when you roll over in a recession, what I think is pretty amazing about this chart is that when you look at it, it took us only 2 years to get back to where we were to have the same number of people employed. Look at the recession back in the global financial crisis. It took almost over 4 years to get to the level of employment we were at the pre-GFC levels. So this one was sharp. It was a fast decline. We've been able to create the jobs back to the economy. This is a positive thing. But again, we have to keep our eyes peeled for our material developments happening within the unemployment and the labor markets. And this is something that the Fed looks at. The Fed looks at the JOLTS report. It's called the job openings. I can't remember what the L and the T stand for. But the JOLTS report is the blue line. It tells you how many job openings there are listed in the U.S. And, some people think that, this isn't a great indicator of actual, jobs available, but there is a massive mismatch. And so if you look at the orange line, what I'm mismatching is against the people who are looking for work. These are people who are unemployed, but consider themselves in the labor force looking for work. And you can see here that there's a gap of about 4 million people that there's 4 million extra jobs than there are people available to work. And so I'd say the positive development in this is that the jobs openings declined significantly last month. They went down by 1.1 million job openings decline to get to that roughly 10 million number. And so this is a positive development because the Fed looks at this, and why I say positive is that it's positive to help maybe slow the Fed's actions through time because we're getting to more of a balance in the labor market. If you listen to Chairman Powell, he talks about the imbalances which exist in the labor market. And so this is another reason why I think they remain undeterred on their hiking, and they're going to get to the levels that we see that were estimated by the dot plots back at the Statement of Economic Projections that were released 2 weeks ago. And then lastly, on the macro side, wage growth is still persistent here. Yes, it's ticked down a little bit on a year-over-year basis. We're continuing to see it to grow at 5.7%. If you use something that is a little more robust and you look at the Atlanta Fed's wage tracker, what that does is it compares the same person. So use the same cohort. So it doesn't adjust for the makeshift that's happening in the labor force. And you can see that number is still at a relatively elevated level. So the Fed believes in the Phillips curve. The Phillips curve just says that there's a relationship between the unemployment rate and inflation. And when there is a very low unemployment rate, where at full employment, that there should be wage price pressures. We haven't seen that for a long period of time since the Phillips curve was actually developed back in the 80s. But you're starting to see that today in the marketplace. And so does that relationship hold through time? I'm not sure, but this is why the Fed is going to continue to remain on their hiking regime. So what does this mean for the fixed income market? As you probably well know, it's the worst year on record. And when I say it's the worst year on record, this is just looking at cumulative returns throughout a year. It's the growth of $1 or growth of 100 from the beginning of each year. And to put this in perspective, not only is it the worst year on record, but it's roughly 10% worse than the second worst year on record. And so this is truly unprecedented with the bond market. That's what happens when you start with very low yields and you enter into a reflationary regime where the Fed is undeterred and hiking. So I think this chart, this could be put up for chart of the year, very simplistic, but just to show kind of what the pain is and why that's bled over into risk markets, whether that be credit or equities. And to dig underneath the surface there, you can look across the various parts of the fixed income market, and you can see there's been significant amounts of pain no matter where one looks. And so things like treasuries and agency CMBS have been some of the best performers that are inside of the Barclays US aggregate, only down 13%. You can see the investment grade market has been one of the worst markets, especially the ones that are in the ag. When you look at the overall IG market, it's down about 18% or so. It's a little worse after the performance on today. But you'll see the high yield market's held up a little bit better, roughly in line with treasuries. That has to do with its interest rate sensitivity. It has a lower interest rate sensitivity than necessarily the IG market does. And then you can see too the pain that's been in the international market. Some of that's dollar driven. Some of it's just that spreads were very tight coming this year. And you have a challenge with some of the strength of the dollar. And there's the fear of QT that's going to ultimately lead to some stress in financing on those who are dependent on external financing of their budgets. And you can see the big winner here is bank loans, floating rate assets. These floating rate assets have done quite well this year. It's tough to really load up on a portfolio of only a portfolio of bank loans, but if you did, kudos to you for doing so. You're in the best performing sector. And you can see the structured credit markets have fared a little bit better than the other things. So everything to the right of that IG side are things that are outside of the Barclays US aggregate. And so as you know, with our asset allocation funds, we use a smattering of these various sectors across the market, and we do some rotation throughout them to try to get to have a better experience. And so far this year, we have been able to outperform the ag, but still no one really cares about that significantly when you have such a horrific negative market. And so we continue to grind away. We've made some more changes to the portfolio, which I'll highlight in the next section. But before we do, let's just talk a little bit more about the fixed income market. Turkey's the outlier here when it comes to the change in bond yields. You can see the pain that we've seen across the board. And for as painful as it's been in the US, it's been worse to be in the Eurozone. Look at that. The UK, I guess they're not technically in it anymore, but 327 basis point rise. Italy 353, Spain 350. I'm sorry, 285, 350 on Greece. So what you're finding is that this is just pain across the globe when it comes to the bond market. That said, the one nice thing about fixed income is pain presents opportunity. And by way of perspective, just look at how much the yield has changed on the Bloomberg US Aggregate Bond Index. And so we went from back in the depths back in 2020 where the ag was yielding about 100 basis points. Now we're at 475. And I think if you're listening to that overlay, I wasn't listening to, I was watching it as we were starting to be in this. I said that, when you see the opportunities in the bond market, they haven't been the levels we've seen in roughly 10 to 11 years. And you can even see this in the ag itself. You're back to kind of pre-08 type of levels when it comes to the yield on the Bloomberg ag. So not surprisingly, investors should be sniffing around these types of assets. The only downside to the Barclays ag is that it has some duration in it. You don't have the ability to go down in some of these credit sectors. And so again, we're a bit biased here, but we do believe that there's the ability to add value to some of those other sectors with careful calculated risk, careful security selection to try to get views on some of the pockets that are very cheap within credit markets today. What's amazing to me is the reset in expectations. And so just to put this in perspective, we have the gray dots and line were the expectations for Fed funds policy at the beginning of 12/31/21. So at the beginning of this year, where are we going to be and where are we today? Just look at the reset of expectations here. This is what blindsided the bond market. This is what's really caused the problems out there. And again, what the Fed's trying to do is get to positive real yields. If you think about the Treasury market, you can go and find real yields out there. This is the TIPS market. The TIPS market offers real yield today. This is the yield you will get above the inflation number for both for all the 2-year, 5-year, 10-year, and 30-year TIPS. What I want to show and really focus on the most is the change in the 2-year. The 2-year TIP at the beginning of this year yielded minus 300 basis points roughly. It accelerated all the way to 180. It was over 2 at one point, but it's 186 basis points today. We've had roughly a 450 basis point rise in the change in real yields on the front end of the curve. 5s haven't moved as much because they weren't as deeply negative. But you can see here that if you want to lock in a rate above inflation, you can go to the TIPS market. Personally, we do not like the TIPS market today because we're afraid of kind of some of the overshoot to the downside in inflation. So yes, we think inflation probably comes in, close to 4% or so next year. You can try to lock this in, but all of a sudden, if we get a repricing of kind of the real yield expectations, it may not be as beneficial as owning nominal treasuries. And so we prefer to take our exposure to the nominal treasury market today. And this gives you a perspective of what rates look like across the U.S. Treasury curve, 2s, 5s, 10s, 30s. You can see here that there's just been a massive acceleration. Last year, I think it was 13 months ago now, the 2-year yielded 15 basis points, and today it yields 434. So there is value out there across the Treasury market. I understand why people would want to buy the 2-year to lock that in, but the 2-year is not going to be a good offset to some of the portfolio risks that you may have. If you want to park some cash instead of buying money market funds, maybe the 2-year looks a little attractive. But if you want to have something that can perform, if we have some recession risk, we have a big slowdown in the economy, we think the back end of the curve, it looks very attractive, both 10s and 30s. And those who follow our work know we follow the copper gold ratio. The copper gold ratio is saying yields are way too high today. It's pretty interesting how the copper gold ratio is telling us the yields are way too low. The economic activity is stronger. Then all of a sudden, with the Fed's policy, it brought in a repricing of the marketplace. And now it's signaling that the market's a little overshot. I don't think the 10-year goes back down to 2% or so. But this does argue that potentially there is going to be some near-term pressure for yields to come down in some meaningful manner. I think that's going to happen once the Fed actually starts to pause and signal that they're getting close to the end of this hiking regime. I don't think that happens in 2022. I think that's something that potentially after the December meeting, I would love to see the Fed pause for at least the next couple of Fed meetings, would push us through March, at least let the rate hikes work themselves in the system. So at that point, potentially there could be some downward pressure on yields. I think in the short term, again, because the 2-year needs to reprice to where Fed fund policy may indeed be going, it should drag the entire part of the curve up with it, which means you have a little bit of short-term pressure probably in yields. That said, I think we're getting very close to the end of this interest rate move. And in fact, we've been putting our money where our mouth is on that. We've been extending duration of our portfolios, and I'll show you that over the last few weeks. And so we've lengthened them quite meaningfully, and I'll get to that when I talk to the portfolio specifics. Just to give a context of both where prices have been, I talked about corporate bonds and then their spreads. You can see here that the prices, I guess these aren't corporate spreads. These actually, when I look at this, this is actually the dollar price of the bonds there too. So I'll just skip that for now. Bank loan default rates have started to tick up, albeit off of a nascent level. This is something to monitor out there. There's been a prevalence of bank loans within the market. Again, we still think that on a spread basis, bank loans, if you manage it well, do offer a potential opportunity, but some of that really low quality stuff should be avoided in portfolios today because they have significant risk in there. Another way to play the bank loan market is through CLOs. You can buy different tranching and different ratings of these. The higher quality ones are down about 3 points. We kind of see that commensurate with what you see in the bank loan market as a whole, but also when you find things like triple Bs today, which again, through a very stressed analysis, you can buy triple B CLOs. You can have twice the defaults that you saw during the global financial crisis. You can lower recovery levels, and these are money good securities. So 12 points of upside, by the way. They have a floating rate coupon. They carry, somewhere at about a 300 spread today. Slap on a SOFR rate on that. You're talking about something that probably yields in the high 6s to mid 7s, depending on where the Fed funds rate ultimately gets. Plus, you have potentially 12 points of upside. There are good opportunities out there in investment grade rated bonds. They're just not really accessible by ETF products out there today. CMBS market, this is the higher quality stuff. This is very duration sensitive or interest rate sensitive. And you can see just the amount of deterioration here. Again, we think that these are money good assets in general. Again, they offer significant upside opportunities just given where prices are today as well. So they carry well, plus they have the potential for capital appreciation. Emerging markets have finally gotten out of their ranges. The old saying we had around the desk is that, they were expensive when they were at a 300 spread, they're 400 spread, they're super cheap. 350 is kind of average. You can kind of see that heuristic work. But however, we saw spikes to the upside in the OAS this year, and we didn't chase this. We actually sold some of our EM earlier in the year as we thought just, again, some of the burgeoning risk. The Fed was adamant about quantitative tightening. Potentially there's a higher hiking regime that was priced into the market. I don't think many of us thought that we'd have a 300 basis points of tightening this year, but it would be problematic for the EM world. We still think this is the case for kind of high quality portfolios. We think EM should be a very small piece of it today. If you're a risk seeker, there are some significant opportunities out there in that below investment grade space today. So there are some attractive opportunities. If you're a risk seeker, there's going to be some defaults out there. But for the asset allocation products we're talking about today, we're at the lower end of a range on our emerging market exposure. I think in the dollar, we've all heard this story all year. We changed our tune at the beginning of the year. Again, with QT, we said, it's probably not the right time to be, owning non-dollar assets. We sold a bunch in January. We sold the rest, or really the bulk of the rest of it back in March. And again, we still have this long-term bearish view on the dollar, but where we stand today, you're kind of in no man's land, right? Do we push up back to this 120 level we saw, or do we start to correct? So We think that there's time for the correction. You need the Fed to slow down. When that happens, that'll give you the signal to go. So assessing the yield landscape, this is what I want to show real quick, is the opportunity set in things that are non-traditional today. And so you can see there, we have the yields of where they were at the beginning of the year. Those are the lighter shadings. So the light gray and the light blue shows you where we started the year. The dark gray, the dark blue shows where you were at the end of the quarter. And you can see here that there's pockets of the market that get you to a level where you can get double-digit yields in the credit market. These are broad-based indices with security selection. You can definitely get there today. And so we think that it's still prudent to own some credit. When you look across it, yes, there's recession risk, but the good news about that is you have something that can now offset some of that recession risk. It's called the long bond. It's called the 10-year treasury. At these levels today, because we own the credit risk, we have been extending our duration in the portfolio and adding to our treasury positions. And that's simply to help offset some of the risk that's prevalent in the credit markets today. And again, we think that the credit markets, they could widen out a little bit with more rate volatility, but you're never going to get the timing exactly right. It's time to put on kind of some of that offset, a positive carry offset. That's the treasury market yielding, 10s and 30s yield roughly 390 to 395 basis points this afternoon. I've seen a little bit of pressure with some of the BOE news as we're going into the webcast today. But in general, we think that it does offer a significant opportunity to offset some of that credit risk in the portfolio. So I don't think investors should just only pile into treasuries, only be unidirectional and assume the recession is going to be imminent. I think right now with where credit sits, it's important to still own some credit. There is enough spread and yield out there to withstand some volatility. Spreads may go wider, but if they do, we do think that rates need to come down. And if they do, potentially there's the ability to rotate out of some of that trade. So obviously the playbook needs to evolve, and we've evolved our thinking on duration over the course of the last month or so. And then lastly, thinking about the opportunity set, if you're going to take your duration, we think you should take it in the treasury market or potentially in the agency MBS market, where those have the government backings and they do act like a risk-off trade. But what you want to pair that with is assets that also have a lower interest rate sensitivity. Notice the high yield corporate market now has about a 4.5-year duration, where a year ago it had about a 3-year duration because, again, the bonds traded yield to call. But instead of owning this investor-grade corporate index or investor-grade corporate bonds that have more duration, they still have some recession risk in there. I don't think there's a huge default paradigm coming in the IG world. Potentially there is some downgrades in some of those assets to jump quality. So in general, as we look across this, we think, when I look across the high quality asset trade, I like the treasury market to be able to put on some of that ability to offset the risk within your portfolio. So let me just run through valuation real quick. This is going to be a speed round just to show you that IG still isn't cheap to long-term trend. Agency mortgages are. They still look very attractive on an OAS. In fact, on a spread basis, they offer comparable spread to the IG market. Non-agencies are in line with their trend on valuation. CMBS is as well. Asset backs are there. High yield, still a little rich relative to long-term trend. About a 1.5 sigma richness. Same thing with bank loans. TIPS market went from grossly cheap to ridiculously overvalued. It's going back in line kind of towards that trend. So this is why when you open up the portfolios, I'm going to show you that we have a bias towards the securitized markets because they're trading closer to either cheapness or kind of long run fair value over the long term. So again, these other parts of the market have been living up the high flying QE days. Munis, very rich. That's something to do with taxation. Very cheap is non-U.S. sovereigns. That's going to be the case until we see some stability in the dollar or at least potentially some downward pressure. EM definitely looks cheap. When it gets to this level, when it starts to rally, there tends to be a significant bounce. And so that's something we'll look for at some point. It's probably a 2023 trade and not the rest of this year, but something that's on our radar. So I know I'm running up on an hour. Let's go through how the portfolios are positioned right now. Hopefully that gave you some insights on what's driving the market right now. Our low duration bond fund, you can see here, a duration of 1.1 year roughly, has a wall about 2.5 years. This is paper that we think is still money good paper. So we don't think there's a big default problem in this portfolio. So it's not like some of the competitor funds out there that are, low duration and high yield securities. This is an amalgamated mix across the sectors of the market. And so we showed the yield to maturity contribution on the left-hand side. It shows that the contribution is coming from various parts of the market. So you're not just wedded to one part of the trade. I was talking to a client yesterday saying, well, why don't you have a heavy overweight to certain pockets of the market? And they were asking about specific asset class. I said, because everything is cheap, right? When you have only one or two sectors cheap, that's when you go significantly overweight those areas once you have a strong fundamental outlook. And so again, securitized credit is a big piece of this portfolio. It does have a lower duration of those markets. There's a fair amount of floating rate securities in here. And you can see this type of portfolio on the yield to maturity throws off about 6%. I just want to let everyone know the yield to maturity, it does use forward assumptions in the floating rate debt. So the current cash flow is a little bit lower than that today. But again, with the Fed hikes planned in the marketplace, seems like a reasonable assumption on how to think about the yield for the next year. The core fund is now up to 6.25 on its yield. The duration was 5.64 last week. We moved the duration out today as we speak. The duration on the portfolio as of today is 5.9 years. We did that by extending out our treasury position. We moved and lengthened out the curve to add to some of those offsets there. We were targeting something like a 395 10-year as a place to do that. We triggered that today, and so we bought in some buy programs to extend the duration. Just to remind everyone, the duration on this portfolio was about 5 years to start the beginning of this year. So we have lengthened out and meaningfully in the last probably 5 or 6 weeks that we've been doing this. So we have moved out the portfolio duration by about 3/4 of a year over that period of time. So again, we think that this is a nice way to offset things for the credit risk we own in this portfolio. Look at the market price of the fund, 83.34. Yes, we'll probably have a few securities at default there. Not everything will come back at par. But if you think about where the yield sits today, there's also the price for there's the potential for price appreciation. So again, securitized, you see 45% of the fund. Some that's government guaranteed on the agency MBS side. And then we have the various credit sectors across there as well. So again, there is a change in the composition of the fund. We are actively managing this as we think we're getting closer and closer to the end of this kind of interest rate push upward. The opposite bond strategy, DB&D, has a yield a little bit lower than 5%, lower than 6%. The reason for this is that it doesn't have a few of those floating rate assets because of the size of the fund. We're looking to add a little bit higher. Very similar kind of asset allocation here. We're starting to see this trade quite well. You can see the market price and these, the dollar price, a little bit higher than what you saw in the core fund. Again, this duration is moved very similarly as well. It sits at about a 5.9 year duration, 9-year duration, 5.9 year duration at today's market close. And then DFlex, our more credit sensitive product, the flexible income fund. Really a credit-centric fund. You can see here this duration has not really moved out. This is supposed to be a credit-type product. Here we have added to the government sector as we did some de-risking last month, or we did it at the end of August, where we just sold like 1 or 2% out of each sector just to de-risk a little bit, and we put them in those very sexy 3 to 6 month T-bills. As we waited for a chance to try to reload on credit, we're still being very patient with this one as well as our credit fund. But notice here, you're getting paid to take the credit risk, 8.65 yield to maturity. So when you think about, when I was talking about wanting to buy credit out there, this is what the credit markets look like today, as we've kind of we've levered up the portfolio a little bit to buy some assets there. But for those that can't buy private placements, DFlex is the closest thing we have out there. I mean, high single digit yield for that type of credit profile. If you want to take down and have a little bit more duration in the portfolio, you could pair it with like a long duration ETF. We have a long duration mutual fund you could use to kind of get some of that risk offset as well. But these are the type of opportunities for those that are seeking replacements for the equity market out there. So thanks for that question. So someone's saying, what are your thoughts on core plus strategies at this point in the yield cycle? I think they're pretty attractive. There's not one single flavor of core plus funds out there. There's some that own credit all the time, that they are highly focused on IG and high yield exposures. Then There's some that really are index huggers. So it depends on what you're looking for here. I'm the most constructive on the bond market that I've been in 10 years. You probably heard that at the opening here, what I said on television a couple of weeks ago, and it's absolutely true. We think there's ways to build these portfolios together. There's going to be a little bit of mark-to-market volatility, but when you look back in 12 to 24 months, you may have FOMO for not doing these type of trades. So we think that the bond market does offer opportunity for people to be able to kind of look back and say, man, that was a no-brainer trade. And so someone's asking, are your thoughts on this? Is it being contrarian because it's bought and hit so badly that it has to get better? Well, it's that, and you couple that idea with their bonds. And if you believe you're getting paid back, if you've done the underwriting on it and things are down 12, 15% because of a reset in yields in the marketplace, and you feel that those bonds will be able to survive to this crisis, they should go back to par. So that is the thesis. So it's not just because things are down, you buy it. It's because things are down, the opportunity set looks very attractive. And now, because of where yields are, you compare credit risk with interest rate risk and be able to offset these things quite nicely. So again, that's why we're lengthening out the duration, is to try to help offset some of that risk as well. What has the highest concentration of double B CLOs of these funds? The flex strategy would, and our closed-end funds would as well. So does the end of the BOE's intervention in gilts market pose contagion risk to the bond market? I'm not sure. It's too early to tell, but the intervention was important while they were sticking to the policies. We have a good paper out on our website written by one of my colleagues, Bill Campbell, about the BOJ. I highly encourage you to go to the website and find it. If you just want someone to send it to you, reach out to fundinfo@doubleline.com. He goes through the thesis and essentially saying that the market in this inflationary environment is no longer accepting, quantitative easing, tax cuts to try to stimulate deficit-fueled financing is really frowned upon. So I think as long as the BOE does not try to, if the head of the exchequer, however you say that word, it wants to continue to press these policies, it could be challenging, but I think the BOE stepping away, let's see what happens. I think them getting out of the market is good for things. Let's see what happens, though. Does your EM team own Russia in these funds? No, we do not. And these days, it's illegal to own Russia, so we don't have any Russian asset. And the question also is the EM dollar denominated or local? Dollar denominated. Next question. Once the Fed's able to achieve a positive real yield on Fed funds, do you expect an easing so that'll include the end of QT? Yes, I think they have to end QT when they start to cut rates. I don't think you can cut rates and continue to do QT. It's essentially, kind of fighting against one another. So if you're going to ease. If you're going to tighten. So, that's the way I think about that now. Who will win the World Series? I don't know. Anybody but the Dodgers is what I root for. So let's go Pods. I want the Mets to win that series because the Padres just stink against the Dodgers. So I don't have a lot of hope for this round. We'll see in the next round. I'll become either a Phillies or a Braves fan in the next round as well. So thanks for that question. Is a persistently strong dollar a threat to the global financial system? Yes, but it's at higher levels than today. So that's why you're hearing the IMF call for some of this. Strangely, we saw someone from NATO say something that the U.S. needs to stop hiking because of the dollar. And it's like, I think Jeffrey actually was the one that said, "Aren't we NATO?" It's kind of strange that we becoming our own policy, but it is a threat over the longer term if it continues to accelerate, and the Fed has to be cognizant of something like that. What impact? That's gilts again. Let's see. What are the important variables the teams focus on before adding credit or taking advantage of the sell-off in credit? I want to see rate stability. Rate volatility has driven spread volatility this year, so we need to see rate stability to do that. Someone's asking me about traditional forms of floating rate when the Fed steps off the gas and also during recessions. Recessions can be problematic for the floating rate market. I assume you're talking about bank loans there. That's how I'm going to answer the question. Because again, if we're having a credit problem, maybe the spread isn't enough there. So even though the coupon, is going down the floating piece, that spread indeed widens. So it can be problematic. If the Fed takes their foot off the gas, and they do so and engineer the soft landing, I think the floating rate market can hang in there. So that's going to be, the $90 trillion question. Are central banks out of the world in sync with tracking inflation? Or are they fragmented? I think they're a fair amount fragmented as we've seen policies this year. But in general, we are seeing a global tightening regime. And so this is what has to happen with it. The big challenge we've seen is that with inflation is that the Fed and other central banks were very reticent to move. They were slow to move. And so now we're playing catch up in this area. Do you feel interest rates have broken out of their multi-decade downtrend? Yes, they sure have. But I don't think that we're in a multi-decade uptrend for the time being. And so I do think that in the next recession in the U.S., that rates do indeed rally. I'm not convinced we go test the lows we saw, last year. I think the market is going to be cognizant of some of the risks that the Fed continue to surprise to the upside, and therefore I don't think that happens there. And then someone's saying, do you see any risk of volatility in long treasury, especially with QT and declining activity among foreign buyers, a risk of a failed auction? Yes, those are important risks in the marketplace. The Fed can stop QT anytime. Don't forget, they don't want to. They want to tighten conditions. They want to suck liquidity out of the system. I think they're very happy with their performance this year. I like to remind people that in 5 months, the Fed hiked more than they did in the last hiking regime, which lasted for over 3 years. So they were slow to respond. They really kind of buried their head in the sand for a while. They did QE for too long, but they definitely have reversed course. So they're not done yet. I thought it was strange, though, that no one asked a question at the press conference about quantitative tightening. Not one single question. It was all focused on dot plots, whether it was the economic dot plots, the Fed funds rate, or the inflation rate. And so there is risk to this. It's something to watch out there. Dealer balance sheets, dealers, don't really step into these markets that well. And so I think in general, liquidity is an important thing to watch, but part of this is by design. QT is supposed to remove liquidity from the system. So with that, let me end the webcast. I think this is my last webcast for the year. So I appreciate everyone's for tuning in today. Thank you for all your support of DoubleLine. I know it's been a rough year across all sectors of the market and all asset classes. And so we continue to work hard. We feel like we have a good position on our portfolio going in to the rest of the fourth quarter and for next year. So thanks again, and tune into my colleagues' webcast in 2 weeks. Take care, all.
Thank you. And that does conclude today's conference. We do thank you for your participation. Have an excellent day.